Welcome to Chapter 4 lecture. I'm going to start out with Exhibit 1, which is on page 151 in your textbook. And I want to just talk about what you're seeing here. At the top here, this is a balance sheet. From here, it's Statement of Owner's Equity, Income Statement, and a spreadsheet. This spreadsheet in the textbook a lot of times says optional. I do not normally feel that it is optional because it's a great organizational tool before you prepare your financial statements. These three forms that you're seeing on the right hand side are considered your three main financial statements. You can see with the arrows that what you do on the income statement gets moved over to the Statement of Owner's Equity, and the answer that you get on the Statement of Owner's Equity moves up to the balance sheet. These arrows here are just indicating to you that if you do a spreadsheet, it can feed over into your balance sheet, income statement, and Statement of Owner's Equity, and we'll get into more of that to that later. This is showing you that on this spreadsheet, the part that's optional is that you're going to start with the unadjusted trial balance, and this just means what is the balance of all of your accounts prior to adjustments. Then the adjustments column, they come right from your adjusting entries. So if you have a debit to supplies expense, you put a debit on supplies expense in the spreadsheet, and then you credit supplies just in that same category. And once you look at a complete picture, you can see that. The adjusted trial balance is what you do after you take the unadjusted and add or subtract the adjustment to get a new balance. So if you had $500 in expenses, you adjusted it $200, then your adjusted trial balance would be $300. So on your homework, you don't normally have to do one of these. There is an extra credit assignment in Chapter 4 that you are welcome to do that does have a spreadsheet. Once you get to the adjusted trial balance, the accounts get fed over to the income statement column or the balance sheet column. The income statement column is going to get all your revenues and expenses. And if they're a debit on the adjusted trial balance, they'll be a debit on the income statement. So you're just moving them into categories. Once again, income statement shows revenues and expenses. The balance sheet takes in all accounts that are assets, liabilities, and owner's equity. And remember, drawing is an owner's equity account. If they're a debit on the adjusted trial balance, they're a debit on the balance sheet. Okay, let's take a more in-depth look at these financial statements. This is an income statement. This shows revenues and expenses. You will see this, you saw this in Chapter 1, you will see it again now in Chapter 4. Revenues minus expenses give you net income. As you're doing these, the list of these accounts, or the amounts in these accounts, are coming from what their final balances are. How much fee earned do you have at the end? And they're adding up the revenues, they're adding up the expenses and subtracting those, and you have a net income of $7,105, which means that you made that much money. Now it does show that this is going to go over to the Statement of Owner's Equity. The Statement of Owner's Equity shows the change in capital over time. So Chris Clark wasn't worth anything to begin with. He made an investment, a $25,000 investment in his company. He made a $7,105 net income for the 2 months, and that comes from the income statement. Less withdrawals, that will be your final balance in your drawing account. And so you add investments and net income together, subtract off withdrawals, and that is your increase in equity. And now he is worth, instead of zero, he is worth $28,105. Now that gets moved down to your balance sheet. Your balance sheet proves that your assets equal your liabilities plus owner's equity. So you've got all your assets over here, you've got your liability and owner's equity over here. Remember that this letter number in the yellow came from your Statement of Owner's Equity. All these other accounts are coming from their final balances. The owner's equity comes from the Statement of Owner's Equity because it has changed over time. Those two numbers have to equal each other. If they don't, you've got something wrong. Now the next few slides are going to talk about how these accounts are broken up, and I'm going to go ahead and just talk about them as you can see them, so that you can look at them as I'm talking. Under assets, you can see that you have current assets and property, plant, and equipment. Current assets are things that we can convert to cash in 1 year's time. So accounts receivable, we normally collect the money for those within 30 days of when the transaction happens. So those things are more current. Property, plant, and equipment are anything that is more of a tangible or an asset that you can touch. A building, a truck, a car, a delivery van, equipment, land, a house, whatever it is that you own. Now those items do depreciate, and so we have to take off their depreciation. So you can see here the office equipment was worth $1,800, but it depreciated $50, so now it's worth $1,750. Land does not depreciate ever, and everything else will that is in this category. Over here we've got current liabilities. There are no non-current ones in here, but those would be listed there if they were. Remember that the difference between current and non-current, or current and long-term, is things that you can pay off in a year. So 1 year is the window for that. And then the capital balance, once again, that comes from your statement of owner's equity, and those all added together should equal your assets. All right, I skipped some of the slides that went through those accounts again. Now I'm on to learning objective number 3, how to prepare closing entries. And before I go over any more of the slides, let's just stop and talk a little bit about fiscal periods and end of the year and that sort of thing. Most businesses run January to December. School districts, however, run July 1st to June 30th. So the calendar year may not be the same as your fiscal year. The fiscal year is whenever your business year starts and ends. So for this purpose, we're going to talk January through December. As December 31st rolls around, you want to make sure that your accounts are all up to date. That is the reason that we do the adjusting entries. There are also accounts that will close out and do a zero balance. Most of your expense accounts will keep track of how much rent you paid for a year. Then we'll zero those out and they'll start accumulating again for next year. So at the end of the year, we close out accounts and prepare those accounts to start over again. We have different types of accounts. We have permanent accounts and temporary. Permanent or real accounts are accounts that do not close. You're going to carry those from year to year to year to year. Cash does not close because you would not want to get your cash to zero. Land does not close because it would be like saying you didn't have land anymore. So most of the time, your most of your assets, most of your liabilities, those are all going to be real or permanent accounts. Now your temporary accounts are going to be things that we do close and get those to zero so that when you start the new year, they will be ready to start accumulating again. Your revenues, all your revenues and all your expenses fall into this category. They are called temporary or nominal, and they do close. The idea, like I said, is to get your balances to zero so that you're ready for the next period. All of these balances are going to be transferred to an income summary account. Now we've hopefully that you've kind of learned that expenses are generally always debits. Fees earned is always a credit. Drawing is always a debit. But right now what we're doing is we're closing those out. We're trying to get those balances to zero. So if you have $1,000 as a debit, how are you going to get that to zero? Well, you're going to credit 1,000 because debits and credits subtract each other. Hopefully you've learned that opposites subtract. Debits and credits are opposites of each other, so they subtract from each other when you're trying to balance out accounts. Now, income summary is an account that we're going to be using just for this purpose. It's not normally a debit, it's not normally a credit, it's not an asset, it's not a liability, it's not a revenue. It is just a temporary holding spot that we are going to use to transfer all of our revenues, all our expenses, and move those into drawing eventually. The drawing account also gets closed. It gets closed. We do revenues, expenses, then we actually close your income summary account, and then we're going to close our drawing. Those are called closing entries. So you do adjusting entries, you do your financial statements, and then you do your closing entries. I've talked about that already. We're going to get those to zero. All right, so what you're seeing here is a lot of numbers. So don't read into it any more than what I'm going to show you. I'm going to circle some numbers and we'll talk about them. The first thing you do is you're going to close out your fees earned and your rent revenue. So you're closing out all revenues, and you can see it says number 1, debit each revenue for its balance and credit income summary for the revenue total. All right, so let's talk about that. Fees earned is always a credit. So in order to close it out or get it to 0, I am going to debit it. Rent revenue is always a credit, but to close it out, I'm going to debit it. So as we look here, we're going to debit those accounts, and the sum of that total will go into income summary. So we would debit fees earned, we would debit rent revenue, we would credit income summary for the total. All right, number 2 is closing out all of our expenses. Expenses are always debits, but in order to close them out, we will credit those. Well, we have to have at least one debit and at least one credit. We've got lots of credits, but what's our debit? We're going to move the sum of all of those to income summary. So if you add 45, 25, 1,650, 985, and all those numbers up together, you're going to get 9,855. So income summary will be my debit. Wages expense, all those expenses will be my credit. So what I'm doing there with step 1 and 2, I'm taking those out of those accounts, out of my revenues, out of my expenses, and I'm putting them into income summary. And when you think about that, revenues minus expenses really give you net income. So if you take $16,960, which is what the debit or the credit balance is, minus 9,855, you get you get 7,105, which is the number that they're getting right here. Okay, that's the second thing. 7,105 is the difference between the income summary debit and the income summary credit. There is a 7,105. So how am I going to get that out? How am I going to get this to 0? Well, you have 16,000 over here, and you've got 9 over here. So you have to put the 7 over here in order for that to be equal to that. So we will debit income summary and credit our capital account. By doing that, it is going to put all my revenues, all my expenses into capital. Income summary just really, its only job was in step 1 and 2 is just to accumulate those numbers in one spot and then move them down together. So now my capital has increased $7,105, which should be your net income number if you go back and look at your balance or at your income statement. Those all should be there. Okay, the fourth one is to close out drawing. So drawing is a debit. I cannot put it in income summary because I've already used income summary and I closed it out. So it goes straight to capital. Drawing is always a debit. So in order to close it, we credit it and we move it into capital. So when you debit capital, which this is the first time we've ever done that, it causes capital to go down. But when you think about drawing, if you take money out, it makes you worth less. So it is going to drop your capital. Here is a list of those accounts or those journal entries that I was just talking about in journal form. There will always be 4 closing entries. They will always be in this order. The only thing that will be different from the picture you're seeing is you may only have fees earned and not rent revenue, or you may have more than that. You may not have all of those expenses. You may just have 2, or you may have 10. Chris Clark may not always be your owner, but those entries will look like that every single time. Remember, debits have to equal credits. And when you do closing entries, you do opposite of what you always do because we have to do that to get those to 0. They have them listed down here, step 1, 2, 3, and 4. That's always the order they go in, and they will always look like that. Now, as you get ready to post these, you can see through these accounts. These are just our ledgers. When we get to closing, the only thing that's different when you post your closing entries are that you're going to write the word closing here. The posting reference is where it came from on the journal page, and then when you cancel these out, they should have lines, or you might go ahead and put zeros in there to indicate that those accounts close out. So all of these are closed. All your revenues, all your expenses will close. The very last step is your post-closing trial balance, and it looks quite a bit smaller than our adjusted trial balance. And the reason is If it's closed, it doesn't go on here. So you'll notice that there's no revenues or expenses at all on this trial balance because their balances are zero. Your debits and credits should still equal each other. That is how we determine whether we've kind of handled our situation, we've done it correctly. I think that concludes my lecture. If you guys have additional questions, please do not hesitate to ask.